Hi, this is the Stuyvesant Square Consultancy with our August 2017 jobs report. Um, if you're new to our discussions, we use the left vertical axis to show the total wages uh, in each sector occupation, the weekly wages average, and we use the right vertical axis to show the number of jobs in thousands that were created in each sector. We use the red bar chart to show the jobs that were created in the month for which we're reporting, and the blue bar chart to show the prior month. And of course, we use yellow, this line here, to show the average weekly wages in each of the sector occupations, and then we show the sector occupations along this horizontal axis at the bottom of the chart. So for August of 2017, the economy produced a total of 156,000 jobs, which the media says was disappointing. In our view, it was a better report than the July jobs report from last month, simply because more jobs were created at higher wages than in July. In July, as you can see, we had a tremendous number of jobs created in the low-wage leisure and hospitality sector, where average weekly wages are only $400 per week. We also had jobs created in education and health services, healthcare, and social assistance, which are largely government supported, government supplemented, Medicare, Medicaid, public schools, etc., etc. You can see also the retail sector is dying. This is the Amazon effect. A lot of retail is not being replaced. We have been warning for months that retail industry shares are declining, and we have been especially warning about investments in retail-oriented real estate investment trusts. If you're in one, we suggest you get out quick. In these other sectors, particularly here in manufacturing, you'll see that this was 36,000 new jobs were created. That is a total of 8,000 in jobs in the non-durable goods sector and 28,000 jobs in the durable goods sector, which pays a little better than the non-durable goods. Those are good jobs. Those are the types of jobs we like to see. They're well-paying. $50,000, $55,000 a year, somewhere in that range. So we're happy to see them. We also had a big jump in construction jobs, which pay in the $1,130 range per week, and also in professional and business services, which pay in the $1,150 range as well. So overall, this was a decent jobs report, and in our view, a better jobs report than in the month of July. Nevertheless, we are concerned about three factors in the economy, and we are counseling people to go either to cash or to put to put stop loss orders, or to buy puts in the 5% downside range. The three things that concern us about the current economy is, first, we're seeing consumer debt service as a percentage of household income as at rates that are equal to and actually higher than they were in the waning days of the Great Recession. So people are carrying too much debt. The second thing that concerns us is the level of margin debt, record high. Very concerned about that. Once you start having a sell-off in the market, when you have that level of margin debt, it's like starting a wildfire in a dry forest bed. And the third thing that concerns us is the continuing drop in the in interest rates overall, and a continued narrowing of the yield curve, particularly between the 3-month and the 10-year. Those lowering interest rates and the narrowing of that yield curve below the 120 basis point level that economists tell us to worry about, that shows that people are moving their money into safe zones. They're not buying into the stock market. So that's why we're counseling. Figure out what a 5% loss to your portfolio would look like. Figure out what the cost of each of those shares would be at 5% lower, and put a stop loss order in at that range. But if you don't want to do that, buy puts. If you want to hold the stock and not realize the sell, you don't want to sell the stock, then buy puts to hedge your portfolio. Buy them at the 5% down range. That's what we're counseling. We don't see a good third and fourth quarter. We suspect that either toward the end of the third or the beginning of the fourth quarter, we will be in recession. The change for that, the only change that we see for that, is successful passage of a tax reduction, and we don't see that coming right now. We first publish our jobs report under our client advisories and our flash reports at www.stisquare.com here. This is where the information is first produced. We also report them up on our Twitter account, which is @StySquare. Then in our LinkedIn account, the Stuyvesant Square Consultancy. Finally, we put the jobs report data up on our Facebook page, which is the Stuyvesant Square Consultancy here. Usually on the afternoon of the report, we make write an exclusive report for seekingalpha.com. That's available free of charge. You just have to register with your name and email on their site, and we go into additional discussion about the economic aspects of the report, the macro effects, and the effects on certain types of companies and stock market generally. And if you wish, you can subscribe to our mailing list. We send out a monthly newsletter that has free and premium content. If you wish, you can also subscribe and become a premium subscriber. That's under the Contact Us information on our website. That concludes our analysis of the July 2017 jobs report. You can read more about it in our analysis on Seeking Alpha. We'll be back again on Jobs Friday in September with the August jobs report, barring any big changes that should affect that might affect the economy or the job situation. Thanks very much. We look forward to speaking to you next month. Stay in touch with us at our Twitter feed, our LinkedIn feed, or on YouTube. We'll speak to you soon. Bye.